Welcome to our deep dive into the financial whirlwind depicted in The Wolf of Wall Street. This film, a beacon for ambitious sales enthusiasts worldwide, left a lasting impression. However, it's essential to peel back the Hollywood glamour to uncover the truth behind Stratton Oakmont's operations. The character Jordan Belfort, portrayed with captivating flair in the movie, only scratches the surface of the company's complex financial dealings. While the film offers a glimpse into the high-stakes world of stock trading and corporate manipulation, it understandably focuses more on the dramatic narrative than the intricate details of financial fraud. The reality is that the true story of Stratton Oakmont involves layers of financial maneuvers that weren't fully explored in the movie. Today, we delve into the mechanisms that allowed Belfort and his firm to amass staggering wealth through dubious means. Understanding Stratton Oakmont's operations requires more than just a cursory glance at their stock manipulation tactics. The firm's strategies were a convoluted mix of savvy financial moves and unethical practices. So, let's unravel the complexities of this notorious firm's operations and understand how Jordan Belfort almost managed to make $1 million a week through illicit activities. Stay tuned as we explore the intricate world of finance, fraud, and the fine line between them. Journey back to a time before the digital revolution, when the stock market was a realm dominated by human interaction, not just clicks on a screen. Jordan Belfort's story truly began after his departure from L.F. Rothschild, a prominent New York stock brokerage firm. In those days, investing in stocks was an entirely different ballgame. You couldn't just hop online and select your stocks with a few clicks. Instead, stockbrokers were the vital link, the human connection in the stock trading chain. These brokers weren't just order takers. They were influential advisors, guiding clients on what to buy or sell. Gathering information was equally old school. Want to know the latest price of a hot stock like GME? In the 80s, your options were waiting for the next day's newspaper or picking up the phone to consult your broker. This limited access to information made stockbrokers indispensable and, in many ways, powerful. Matthew McConaughey's character in The Wolf of Wall Street highlights a stark truth. Predicting stock movements is an unpredictable game, even for the most seasoned investors. Yet, stockbrokers thrived, not on their predictive prowess, but on the commissions they earned from trades. In the 90s, commission fees were the norm, often as high as 2% of the total trade value. This meant substantial earnings for both the broker and the brokerage firm. Jordan Belfort's later experience at Investor Center, depicted in the movie, is an accurate representation of the high-stakes, high-reward world of stockbrokering in that era. In the world of stock trading, over-the-counter, OTC brokerages play a game quite distinct from their exchange brokerage counterparts, such as L.F. Rothschild. While exchange brokerages operate on public platforms like the NYSE, with stringent regulations and oversight, OTC firms navigate a less regulated terrain. Exchange brokerages, with their teams actively participating in the bustling environment of stock exchanges, adhere to stringent standards. This environment, despite its vulnerabilities to manipulative tactics by brokers seeking higher commissions, maintains a degree of regulation to preserve the integrity of the exchange. Brokerages that step out of line risk expulsion, a death sentence in this arena, as access to trading is their lifeblood. In contrast, OTC firms operate without the constraints of exchange regulations, offering a more flexible and less scrutinized space. This flexibility allows for direct engagement with companies seeking funding without the rigorous vetting processes standard on exchanges. Imagine a company approaching an OTC firm, seeking $1 million for a cutting-edge radar technology with dual applications. The OTC firm might agree, but at the cost of a significant portion of the raised funds, sometimes up to 20%. This structure inherently attracts a mix of genuinely ambitious companies desperate for funding and others with less scrupulous intentions. The film The Wolf of Wall Street may have exaggerated with the 50% cut in fundraising. In reality, OTC brokers' earnings from such deals were more likely in the 10–20% range. Yet this high percentage is telling. Companies offering such a substantial portion of their funding to brokers are often risky investments. This backdrop sets the stage for Jordan Belfort's Stratton Oakmont, initially a subsidiary of the modest Stratton Securities capable of trading both OTC and exchange-listed companies. Belfort, along with his partners Brian Blake and Danny Porish, the latter portrayed as Donnie Azoff in the 2013 film, eventually took over the firm, marking the beginning of a new era in their business approach, one characterized by high-pressure sales tactics targeting less experienced investors. Jordan Belfort's journey at Stratton Oakmont was a step beyond just making good money. He had higher ambitions and a scheme that would eventually define his legacy. He formed a team of aggressive brokers, primed to pitch any stock he chose, setting the stage for a manipulative game of stocks that would redefine underhanded tactics in the financial world. Belfort's strategy began with coordinating with rat holes, connections who would buy substantial shares in small-cap companies, typically those under $100 million in market value. Once these rat holes secured significant ownership, Belfort unleashed his brokers to sell these stocks en masse, creating a buying frenzy that inflated the stock prices. This frenzy was fueled by enticing pitches about rapidly rising stock values, luring more investors into the trap. As the stock prices soared, the rat holes would start offloading their shares, making substantial profits. Meanwhile, regular investors found themselves trapped, unable to sell their stocks due to Stratton Oakmont's brokers intentionally avoiding their calls or losing their trade orders. The moment these investors could finally sell, the stock prices would plummet, leaving them with significant losses. This devious strategy reached new heights when Stratton Oakmont began handling initial public offerings, IPOs. IPOs, the process of a company going public, normally involves stringent rules and regulations. Companies typically turn to investment banks for underwriting services, ensuring the IPO's success. However, some companies were swayed to use Stratton Oakmont's services instead. Contrary to expectations, the introduction of public exchanges did not hinder Belfort's operations. Instead, he ingeniously combined the unregulated nature of over-the-counter transactions with the credibility of publicly traded stocks. He would have his rat holes purchase shares in a company before taking it public, then have his brokers aggressively sell the IPO stocks. This not only inflated the stock prices but also attracted external investors, oblivious to Stratton Oakmont's machinations. This entire operation was essentially a pump and dump scheme, a now infamous strategy that propelled Belfort to amass millions. For a time, it seemed such schemes were fading, particularly with the advent of online trading platforms and greater market transparency. However, the loosely regulated realm of cryptocurrencies has seen a resurgence of similar tactics. The key players have shifted from stockbrokers to online communities and influencers, and penny stocks have been replaced by meme coins, demonstrating how old manipulative strategies find new life in evolving financial landscapes. So, dear viewers, we've just delved into the cunning world of Stratton Oakmont, a historical lesson on stock market manipulation. Jordan Belfort's era reminds us that as financial platforms and products evolve, market manipulation tactics find new guises. It's a crucial reminder that in the age of cryptocurrency and online communities, we must remain vigilant and informed. Stratton Oakmont's story isn't just about fraud and greed. It's a lesson on the importance of ethics and transparency in financial markets. As investors, we hold the power and responsibility to seek knowledge, ask questions, and make informed choices. And what about you? What lessons do you take from this fascinating story? What are your thoughts on the challenges and pitfalls of today's market? Share your views in the comments, and if you found this video enlightening, don't forget to leave a like and subscribe to the channel for more in-depth analyses and intriguing stories from the finance world.